Schweitzer is one of our board members, as is Roger. Let's give him a round of applause. I want to give it up to our guests for coming. There's 3 visitors from the Federal Reserve. We've got Sam Chapman from Cleveland right here. Raise your hand, Sam. We've got Doug Campbell from the Cincinnati Fed right over here. And then we've got our guest, Mark Schweitzer. And I'm just really glad that the Federal Reserve, when we first asked them about coming here, they said that they wouldn't come and they wouldn't do a class, and we talked about it. And really, I'm just happy that they decided to come and be transparent with everybody so that everybody can learn a little bit more about the Fed. And what we've got tonight is a real expert on our hands. Mark Schweitzer is the Senior Vice President and Director of Research at the Federal Reserve Bank of Cleveland. He leads the bank's research department. As most of you have seen, the Fed's been very much in the news, and it's what he does. It was his job to brief the bank president prior to the meetings of the Federal Open Market Committee, which is the committee, I think Mark would tell me, that just made the decisions last week for the next round of quantitative easing. And Dr. Schweitzer's research is focused on macroeconomic impact of labor markets and factors contributing to regional economic growth. He joined the Fed in 1992 as an economist and served in a variety of positions there. In 2007, Dr. Schweitzer was appointed Vice President of the Federal Reserve Bank in Kansas City's Denver branch. He's an economics graduate from the University of Chicago, and he lives in Shaker Heights and is married with 2 daughters. Let's welcome Dr. Mark Schweitzer. We pass around cards. If you need a card, raise your hand. What we're going to do is collect all the cards and kind of ask like questions when we start taking questions. And then there may be some time at the end we can ask some questions from the floor. We get through everything.
Great, and actually I'm quite happy to be here. In some sense, I don't go out and help people teach classes, but this is not a traditional class. And this is a group that I'm happy to talk to and happy to get questions from. So I definitely want to reserve time at the end for questions. Before I get too far, though, I need to have our regular disclaimer. So my bosses know that should I have misstated something, that was my opinion and not theirs. We have to be careful with that. So I am going to talk a little bit about an overview of the Federal Reserve System, but I'm actually not going to spend that much time about that. So there'll be a little discussion of structure and some of the lesser known roles. I actually want to focus our attention today on monetary policy, because I think that's where most people in this audience questions are. And that's actually, what I'm, most used to talking about. And in particular, I'll take a look at the most recent FOMC statement. I think, it is something that has attracted a lot of attention. And you may have questions about, how I think about it. Remember the disclaimer that came right before this. And then if we have time, I might go over a little closer to the mic, okay? I might go over a little bit of some of what people may be, how I would see some misconceptions and what you see in the public sometimes about the Federal Reserve. So, when you're thinking about the Federal Reserve, there are these different components. And the creation of the Fed was designed to sort of move it out of just the Washington, D.C. sphere. So there are the Board of Governors, and that's where the chairman is. He's the Board of Governors. But then there are the 12 regional banks. And the regional bank for this area is the Cleveland Bank. And this helped to make the system more representative of the population and more, less New York, Washington, D.C. centric. So I think that's a useful thing to see. When it comes to the actual voting on monetary policy, that is done by the Federal Open Market Committee. And this is a rotating group of presidents along with the governors. So at any given time, you've got the voting members of the FOMC. They're the ones who set the monetary policy for the country. And, it's an odd collection of districts Cleveland Federal Reserve District, that would have been a very strong steel making, coal mining. This was heavy industrial production. And there are two sort of critical things that help organize how these boundaries are set up. There was an effort actually to break up states. So you'll see if you're looking at the 4th Federal Reserve District, we do have all of Ohio. But we have part of Pennsylvania and part of Kentucky. And that was part of trying to take the monetary policy system and say, okay, this needs to be sort of separately representative of the country and not too tied to any particular political environment. So that is one of the things that was set up when we established the Federal Reserve System. As you get further west, you get a lot of complete states. There weren't so many people, and it was very dependent on how you had transportation lines. So the Kansas City Fed was an excellent place to have a Fed because you had all the rail lines heading west. And that was how you transported the money, that's how you made sure the communications were open. At this point, though, what do these different Federal Reserve districts do? They give a variety of different perspectives that come in from around the country rather than sort of being a part of the Washington, D.C. government. So when you're thinking about roles of the Federal Reserve, we do think primarily about monetary policy. We do have supervision and regulation functions. We have state member banks, and those are banks that we regulate. We also regulate the holding companies of larger banks. And that's probably the most important form of regulation. The Board of Governors establishes certain rules, although it has a relatively limited range of rules that it can establish. We do have a lot of financial services. Over time, those have become very electronic. If you went to the Cincinnati branch 10 years ago, you would have seen that it was processing millions and millions of checks. We actually had an office also in Columbus that was processing lots and lots of checks, and it was nothing but checks. In the entire system now, we are down to one place that processes checks, and that's Cleveland. So for whatever reason, Cleveland's really good at the dying business model. The entire role, the Federal Reserve System is shrinking. If you were to look at employment numbers, you would see that this is a part of our economy that's shrinking. It's shrinking because technology has made our ease of transferring funds and meeting transactions easier and easier over time and less expensive. So in Dodd-Frank, which is one of the ways that we came to have a little more financial stability, it became a little more identified what parts of financial stability and how do you oversee that. That's one of the questions that certainly is still being worked on. But throughout the Federal Reserve System, there's always been a role for financial stability. And central banks throughout the world are what are considered lenders of last resort. So when you have liquidity issues and there's not enough, somebody has assets that are valuable, but has a shortage of the means to pay at the moment, those banking concerns are handled by central banks throughout the world, and that's true in this country. And then finally, we're going to focus a lot on monetary policy today. So the Federal Reserve is given a dual mandate. This was established over time. Initially, we were set up with more of a discussion about financial stability. Over time, the mandate was made clear that we should focus on maximum employment. To think about what does that mean as an economist, I want to recognize that we can't have 100% employment. That would be an environment that doesn't work when we want to have people moving from job to job. So we're always paying attention to what does that maximum employment mean. And that involves figuring out what you think is kind of a normal or natural or long-run rate of unemployment. And currently, the FOMC has different estimates. So the committee does not agree on sort of what the long-run natural unemployment rate is. Those estimates run from about 5.2 to 6%. And our bank is one of the banks that's public about it. We think it's about 6%. On the high side at that time. The other thing that we're very focused on is stable prices. described as price stability is an inflation rate of 2%. Now, I think some people here may think that 0 is the right number, and I'll talk a little bit about that later on. But I think what's really kind of important here is that we went from an economy where inflation rates were above 10% at certain points of time, down to one where we're very much in the vicinity of 2% on a longer run basis. Now, this price measurement is measured in an inflation measure called the PCE inflation index, and I'll talk a little bit about the PCE inflation index. So, what is normal monetary policy is a setting of the federal funds rate. The federal funds rate is a bank-to-bank market where banks lend each other money. And this is done in an environment where there's a target rate, and the New York Fed and its desk operations help to set that target rate. The Fed funds rate adapts to current conditions and to make sure that it's lined up with other interest rates, essentially to hit the dual mandate, to do as well as we possibly can at seeing employment move towards maximum employment while prices stay stable. As you can see, prior to the crisis, the Fed funds rate had risen to about 5%. That's actually not a very high number in longer-term perspective, but as the recession and financial crisis came, the federal funds rate was lowered several times and is now very close to 0. So there are, of course, other monetary policy tools. One of those is the discount window lending program. So when people think about the Fed being involved and having lots of activities during the financial crisis, a lot of that would have been organized through the discount window. The discount window is a short-term lending facility. It's always been part of the Federal Reserve Act from the very first day. It takes an asset that's unliquid that a bank has and will lend out funds that are more liquid so that they can meet short-term liability, short-term needs. But I think one of the things that's worth knowing about that is that when we run the discount window, it's called the discount. And that's a very odd thing. Why are we discounting things? Well, it's not discounting them in the way that you might think. Each one of these loans, we take collateral. So you give me a treasury bill. I say, oh, great, I'll lend you 85 cents on the dollar. Treasury bill will actually be a little higher than that. But it depends on the quality of the asset, and we give each one of those assets a haircut. And so when you're thinking about lending during the financial crisis, it is true that over time, broader sets of collateral did get presented, and broader sets of collateral were accepted. But each time you were looking at something that had more risk, it gets a larger haircut. And the discount window people who run that, are always there to emphasize that they don't lose a penny. Because in general they don't, because the collateral that was presented had a market valuation, and then we took a haircut off of that market valuation to protect ourselves from the risk that that market valuation might change. And so the discount window lending program is something that addresses liquidity needs, but actually doesn't involve nearly the risk that I think a lot of people think it might. We can change reserve requirements. That was last done, well actually I'm not positive on that was last done, but that was prominently done in the Great Depression. It didn't result in such a good outcome. So you don't see a lot of adjustments in reserve requirements anymore. Interest on reserves is a new feature. So we've been taking reserves or holding reserves for banks. And those reserves that the banks had on our books were not, we paid no interest on them. As part of recent actions, we can now pay interest on those reserves. That helps us manage the short-term money markets and to help hit the federal funds rate target. And so this actually is essentially removing what was viewed as an implicit tax on banks. Banks were required to hold reserves. We paid no interest. If you have a moderate level of inflation, that is a small tax on the bank. And when inflation was higher, that was a larger tax on that. So here's the big numbers. So the big numbers about where are the various parts of the Federal Reserve balance sheet. So I want to be upfront about this. And not only are we upfront about this, this specific graphic comes from our website. You can go see sort of where is the balance sheet and what programs is that connected with. So if you look over there, you can see that sort of pre-crisis, most of it was in Treasury holdings. That's what we hold when we issue currency. And the flat line is sort of what levels of currency, and there was some growth there to account for growth of currency in the economy. Since you come into the financial crisis, you get a large growth in lending to financial institutions. And that's that brown area. But you can see that that area has gotten small over time. There's still some lending going on, but not actually that much. In the financial crisis, there were programs that lent to broader market areas that were not directly backed. That's that red area. You can again see that was fairly large activity in the financial crisis, but that money is generally all paid back. The green area is the purchases of mortgage-backed securities. The purple area is the purchase of longer-term Treasury securities. So we will talk a little bit about both of those programs. So the FOMC just had a meeting. It was my job to be there at the meeting. When you're thinking about what was going into the meeting, I want to start out with, so how do we assess where the economy is today? So here are the key facts. Growth in employment has been slow. Unemployment remains elevated. Household spending has continued to be, pretty moderate. Business fixed investment has also been pretty slow, and inflation has been subdued. Longer-term inflation expectations have remained stable. So I'll walk through each of those. How do we interpret those things? So here's a chart that we would look at when we're thinking about employment. I want to be looking not, across the economy to see sort of where are we seeing employment growth. And what you can see is if I'm looking at the August numbers, that would be the brownish squares, that those were, definitely lower than July in most cases, and also lower than what we've been seeing earlier this year. So there was a notable slowdown in employment growth. This is perhaps a more important picture. So we have been seeing some gradual progress on the unemployment rate. And if you look up here on the line, you can see, I'm going to mark out there with a shaded area where the recession is. You can see the sort of tremendous growth in the fraction of our workforce who's looking for work. And over time, we've seen that number come down, and it is down to about 8.1%. But as an economist, this isn't necessarily the best indicator for what's going on in our labor market. And I actually like the one that's also shown here, the employment to population ratio. What this asks is, what fraction of our overall working age population is working? What you can see here is that pre-recession, we had about 63% of our potentially working age population that was working. And there are many reasons why people are not working, and among those not working are retirees, for example. Now, over the recession, that number fell dramatically. And when you're thinking about what sort of employment growth do we need, we'd like to see this number rise again. Because this is an exceptionally low employment to population ratio. So we basically lost from 63 down to just a little bit above 58. We lost about 5% of our population that was working that's no longer working. In a more healthily functioning economy, we would see more of that 5% returning to work. So what about output? We've been seeing very moderate output growth. I've got the initial estimates here and then what we were learning in the last couple months. You can see that more or less across the board, there is growth here. There was growth in many sectors. I mean, perhaps one of the more interesting changes has been that residential investment is starting to grow again. So we are seeing more home construction. And we've actually been doing fairly well on the net exports. So exports are a positive GDP, imports subtract from our overall GDP growth rate, and we actually have seen that getting smaller over time. Government spending has generally been shrinking. So what about inflation? So I wanted to talk a little bit about inflation measures. The inflation measure that people are most familiar with is the CPI. And so this is going to cover a basket of goods and services that households consume. They're measured and updated they're updated more frequently, but there's a major update every 10 years to make sure that the basket reflects what people are consuming. And then there are a set of people who go measure prices for both of these baskets, and it's calculated to figure out what the inflation rate is. We've got a 2% objective. That's in the PCE form of inflation. The PCE is personal consumption expenditures. The advantage of this measure is that it covers a broader range of consumption goods. It covers things where prices are somewhat hard to find, like banking services. Participation in groups like this, if there were payments that were being made for a community group, then that would be in the personal consumption expenditure basis. Personal consumption expenditure turns out to be typically about a 0.5 percentage point lower on the inflation rate than the CPI. But as you can see here, the patterns are really quite similar, and the actual numbers have been at times very close on the PCE and CPI inflation rates. Now, an interesting fact is that if I were to look over the last 3 years, the average inflation rate is 1.5%. So this is including your food, your energy costs. Overall, we're getting about an inflation rate of 1.5% on either of these two bases for the last 3 years. When we think about measuring inflation and following it, in particular focusing on where inflation is going, at Cleveland Fed we spend a lot of time looking at the price data. And we actually calculate some alternative measures to help us predict where inflation is going. So if I'm thinking about the overall CPI index, that would be the all items rate. And this would show you sort of where is the CPI on a 1-month basis. And so some of you might think, okay, well, 7.5% in the month. So it definitely was up. That was a very big energy price index change. Over the last 6 months, it's up 1.5%. Over the last 5 years, it's up 2%. When we're trying to think about where inflation goes, though, we recognize that this energy price is moving a lot. So in the last 2 days, I think oil prices have come down $6 a barrel. So that's the sort of volatility that can actually change your index a lot. You don't want to infer too much out of that, because the fact that energy prices came down $6 a barrel these last 2 days doesn't actually tell you very much about what energy prices are going to do over the next 1 month, 2 years, any particular period. So we use the median and the trimmed mean. So we don't want to just throw energy out all the time. So the median says what is across our distribution of price changes, what's the middle price change? That turns out to be a very good predictor of inflation over the next coming year. So we use that. The trim mean is a similar estimate. What about inflation expectations? So there are, of course, a wide variety of people who have a lot of different views on what's going to happen to inflation. And there's nothing really surprising about that. The one that I actually think is really interesting to look at are what are the financial markets building into their treasury and their interest rate actions. So at the Cleveland Fed, we've got a model that we use to pull the inflation expectations out of treasury and nominal treasury yields and something called inflation swaps that are financial traders trading on what they think inflation will be. What this chart shows you is what the embedded cost of inflation is in the Treasury bills and bonds throughout a longer horizon. So you can see that out on the longer end of the horizon, they are getting up to that 2% level. But inflation expectations, as they are incorporated into bond prices, are very low. So the market, the people who are trading actively on this margin are building in a strong estimate that inflation will in fact be low. So if we're going now to the actual statement, so at each meeting, the Federal Reserve Bank presidents and the Board of Governors meet. It's a fairly large table, very similar to many other boardrooms. They discuss the situation, and then they come up with their description of the economy. So I'm taking little quotes from the FOMC statement, and in this particular one, there was a very strong statement that without further action, that employment was not progressing very quickly, and that inflation over the near term would probably run at or below its 2% objective. So let's take a look at what does the committee tell you. So the committee is going to tell you both what motivated its decision, but it'll also share with you what its forecasts are. So this is something that's come up during the last few years, that the committee is more upfront about exactly what is it projecting for the economy. So here I've got, and I'll have a few of these slides, here I've got two different sets of projections. The ones that are in blue are from the June meeting, the ones that are in brown are from the September meeting. The bar shows you the range of what we call the central tendencies. The little whiskers that come at the end show you the full range of all participants, because they don't agree. They have different views on how the economy is likely to evolve. Over time, though, you can see that the expected growth rate for this year was pushed down. The committee felt that over the summer, what we've learned about how the economy is developing is that we should expect weaker growth. Growth in the coming year, though, doesn't look very bad. And growth in the third year out, 2014, would be actually a pretty attractive number because of today's numbers. Over the longer time period, we would expect that a normal and healthy growing economy would on average grow about that 2.5% range. At 2.5% is kind of a representation of normal growth. And so sometimes you'll hear this as potential growth. What about unemployment? We've been seeing unemployment running a little bit above 8%. The forecasts between June and September are not very different. And we're expecting to see a pretty long path towards what we consider normal unemployment rate. So remember when I was talking about the objectives, I said the committee is clear about what is its expectations for where unemployment would go. It should go, somewhere between that 5.2 and 6% range. And you can see that that comes from the central tendency of the long-run expected unemployment rate. And there are, of course, whiskers around that, so there are some people on the committee who believe that long-run unemployment is actually clearly higher than 6 now. And there are some who still think that it is below 5%. What about inflation? Inflation is expected to be below 2%. This hasn't really changed very much. You can see that there was a slight pushing up of the near-term forecast on inflation. That inflation will actually, there's some uncertainty about that range. But then on the longer run, you see that the committee agrees that in the long run, what we should be aiming for is a 2% inflation rate. And then there's an equivalent thing to focus some on the core measures of inflation. That's part of that, looking to see sort of where we think inflation is going. So this suggested that we would have a highly accommodative stance. So this is taken straight out of the committee's language. That monetary policy would be appropriately accommodated for some time. And that the federal funds rate should remain at these essentially very low levels. And in fact, now the committee is actually very straightforward about what is it thinking. What does it mean when it thinks that it will be long for a low for quite a while? And here I have a set of different forecasts from this year because I wanted to make the point that we say it's likely to remain low for a long time. Currently, if I were to look at the September number, most of the committee members are expecting that rates will stay low up until 2015. What you can see, though, from this chart is that, more than the forecast moved around, these move around. So as data and other things come in, there are the committee says, okay, I think growth is going to be a little stronger, inflation is going to be a little higher. That will change sort of how policy responds. And that, this is one of the easier ways to see that. And then this chart shows you the September numbers, but it shows you them in a way that you can see that the committee is actually truly a committee. It is not a single voice. You can see that most members are expecting the Fed funds rate to stay low. Each dot represents a member. But as you get into 2014, you get people who are expecting the Fed funds rate to be quite a bit higher, that we will need to do that for policy to be set right. And then by the time you get to 2015, you're seeing a broad range of different ideas about where the Fed funds rate will need to be once we get there. But again, that's very dependent on the forecast of the individual committee members. So how does this work? Now I know this is going to be one of the things that people wonder about. So when we make a statement about how long low rates are going to last, that influences the market to think about, well, how do they expect policy to evolve? So this has an FOMC statement release, comes at 2 p.m., and then we look at what happens to Treasury interest rates on Treasury bills as an indicator for the general rate structure. And those rates both fell right with the announcement because it's clear that you're likely to see those lower Fed funds rates for longer. Of course, it's not solely a matter of treasuries, and so in this particular FOMC policy action, there was support and agreement on purchases of mortgage-backed securities at a pace of about $40 billion per month. So what did that do? Well, that had the effect of lowering the yield on mortgage-backed securities, which ultimately has the effect of lowering the interest rate on mortgages. Now, it doesn't remove it from the market. It just says that this market now has this little extra support. And you can see here that you're basically talking about a couple tenths of a %. But over time, and this is maybe the better way to think about how policy is acting, over time, you will have seen that the interest rates on different products that reach consumers and businesses throughout the economy, the interest rates are getting lower. And so here I've got a chart of, several direct-to-consumer interest rates to show that over time, while, they're certainly variable, and they continue to vary with all sorts of different market factors, that the policies have generally encouraged these rates to become lower. Looking across a whole range of different kinds of activities, you can see that if I compare today's rates with rates that were applicable in our economy, in this case in January 2007, that broadly based, the interest costs of borrowing have declined. And that's true whether you're looking at a consumer loan like a new car loan, or you're looking at a business loan like a BAA, bond that a firm might offer. Now, one of the things that I think, so a lot of people look at that and go, well, how much does that cause businesses to change their behavior? How much does that cause households to change their behavior? And one of the things that is happening as a part of this policy response is that households had an awful lot of debt. That debt level had gotten to be quite high. This is a chart of the debt service ratio. So this is the cumulative decisions of many different households. That debt service ratio reached 14% prior to the recession and has declined sharply in the recession. But I think importantly here, you're seeing that the debt service ratio continues to decline now. So when I think about household balance sheets, one of the things that happens here is by seeing lower rates, households are actually able to save some of their borrowing costs and are able to see their debt service ratio decline. So their household balance sheets are improving. So finally, the committee will continue to monitor the incoming data, and I think that's a very critical statement, is that we are always keeping an eye on how things are looking. The committee intends to act because it has a dual mandate until labor markets are improving, but I think one of the things that is somewhat neglected here is that it will do this as long as we're seeing continued price stability. So that means that we're not seeing the inflation rate move significantly beyond the sort of 2% level that is the target. It should stay in that vicinity. So I wanted to take a look at my clock. So I will save the misconception slide, and I will take some of the questions that are really piling up down here.
Okay. With countries such as China now threatening to dump the dollar and many others looking at returning to the gold standard, what does this mean for the dollar, the U.S. economy, and the future of the Federal Reserve? How soon can we return to a gold standard?
Okay. So I did prepare something on gold standards, so I did want to talk a little bit about that. So here's the price of gold versus PCE inflation. So this is change in price of gold and change in price in PCE inflation. What you can see here is that gold prices are a very volatile price. So when we think about gold standard, there's some sense about stability coming out of gold. But the way gold actually turns out to be a very fragile market. And one of the examples that I would point out about thinking about time to something like gold is that if you get a central bank, and it doesn't need to be a really large one, like the Swiss National Bank, deciding it wants to sell some of its gold reserves, the price of gold will move very quickly in that environment. And so, or if, for example, you've got a bank that says, hey, I want to expand my gold supplies. The fact that so much of the gold is captive in governments, captive in central banks, means that the margin, the ability to buy and sell, makes this a very volatile price. So when I think about it as an economist, it's the last thing in the world I want to be tied to is a very volatile price. So I thought I'd show you, thinking about nominal per capita incomes in the U.S., deflated for real change in the PCE inflation rate. So I've got a nominal per capita income, and that's shown in green. And of course, we would want to account for the inflation rate. We would want to adjust it for that. And that's the brown line showing you real per capita income. If I had deflated that by gold, it would have, gone up and then plunged. So this is just taking gold at a single sort of annual average rate. I don't know as an economist that I would think that that's a really great idea to have both prices going up by such an amount or prices coming down by such an amount. That seems to me to introduce some instability to our economy.
As a follow-up.
But again, that's my perspective. I would say on the China fact, so I think one of the things that it is true that the Chinese government holds a lot of treasuries. They have at times talked some about diversifying their portfolio. The fact that the Chinese government is managing the exchange rate gives them very limited ability to sort of significantly alter their portfolio. It's not something they can do without fundamentally changing their exchange rate. The Chairman Bernanke has several times urged for countries to have more of a floating exchange rate so that they don't have this sort of inherent tie to asset accumulation from the U.S.
And as a follow-up to that, what would have changed from when we used to be on a gold standard as compared to now?
Well, so there were times in the historical period where you would see gold swings that were fairly large. As you get a bigger and bigger economy with more and more goods out there, and the gold supply has actually sort of not changed so much, it makes it a more fragile market because you've got a narrow range of gold that's trading. So if you're thinking about, hey, how do I tie a much bigger world economy to a market in which 90-some% of the gold is held in government hands, it makes for a very fragile margin for that remaining part. So over time, we've seen gold become more volatile. I would admit that if you were to work on somehow trying to get the Federal Reserve or some other central bank to have more of a gold focus, it might stabilize some. But inherently, the fact that there's so little gold trading relative to the size of the economy can make it a very fragile and very abruptly changing price.
Do you agree that the Federal Reserve should be audited by a firm or agency outside the government control?
So where's my audit line? So we actually are very much audited. So the Federal Reserve Bank of Cleveland is audited by PricewaterhouseCoopers. So our books are always audited by a private entity. That same private entity, examines the books of the general Federal Reserve System. I think the more critical auditing actually happens from the chairman and others in the Federal Reserve System having to go to Congress and face the questions of senators and representatives. Sometimes their questions are better than others.
Okay, let's take another one. If the Fed were ended today, what do you predict would happen to the economy?
That would depend very much on how you end the Fed. I have really, that depends very much on, sort of how do you think about, how do you adapt? You can't, modern economies, whether they were part of the Soviet system or part of, very free market economies, have central banks. They need banks to intermediate between banks. I'm not exactly sure how we would resolve, if we were ending the Fed, we would have to have certain components of what we do in the Fed still done. And I don't know exactly, how that plan would be structured.
As your presentation presented, the Fed's two main responsibilities are to keep inflation down and to stabilize the employment picture. But many people seem to think that the CPI has been kind of dumbed down and that inflation is much higher than is really being represented. And at the same time, the level of unemployment is much higher than is also represented. Could you speak to that?
I'm not sure who turned in the question, but I think
It was me, actually. I'm sorry.
Very
It's one that's been on my mind.
So let me, on the inflation rate, it is the case that, households actually think that inflation is running a little higher. If I looked at the average household, households actually say inflation is about 3.5%. But some households actually think inflation is 7 or 8%. So there's a range of different opinions, and some households see it as really quite a bit lower. So, there is, I think, it's not so easy to think through all of the things that you purchase. And I think this may actually help you. Let me go back to another chart that I had in my... So here's the CPI components, price change distribution. So here's the actual data that's going into last year's inflation rate. So if you were heavily focused on, I can't actually read this out.
Water and sewer, trash
Trash collection services. If that was a major part started your budget, this was an extraordinarily bad year. Now, each one of these categories is weighted by the share of the average consumer spending on that item. And you can think that, if I go down here a ways, sort of near the middle, I've got something that's called OER. So that's how much it essentially costs to rent your house to yourself. And so that's one of the stable prices, that's one of the relatively large components. How much are your housing services costing you to use? Just the ownership of the house. So,
Can I ask a question here?
and over the last 12 months, from, let me see when this goes through, from August of 2011 to August of 2012, gasoline prices nationwide are down. Now, they're up from earlier this year. So if I were to show you the same chart over, say, the last 4 or 5 months, you would see that gasoline prices are up. One of the reasons why we don't like looking at gasoline prices as economists is because they are volatile. Next month, and I know some of you are going to doubt this, but given the recent oil price trends, you should see gasoline prices fall over the coming months.
Let's go to another question. We've got a great attendee who asked this question. Richard Fisher, president of the Federal Reserve Bank of Dallas, told Bloomberg News yesterday that QE3, the third round of bond purchases, will probably fail to create new jobs while risking higher inflation. What's your response to Mr. Fisher's statement, and how can financing our debt and printing more paper money help decrease our debt?
Okay, so there are a bunch of different questions sort of encapsulated in that. But let's sort of walk through it. So Richard Fisher is thinking that you will see relatively little impact on employment coming from the purchase program. So he says no impact in that statement. I'm not, I read the statement when I saw it yesterday. So he's not, that's not the general view of many economists nor of the overall committee. The committee is agreeing that they think that this is an action that should be taken. How does this happen? How does it matter? I think, in some sense, that's why I tried to walk you through having lower interest rates helps households lower their debt burden. Lower interest costs to households reduces their, liabilities versus their assets. Households that are in better shape, have better balance sheets, who are able to see that their household balance sheet is in better order, are able to go spend more on the overall economy. Spending more on the overall economy helps to promote growth.
Here's kind of a basic question that I think really is on everybody's mind. Who does the Fed report to?
The Fed reports to the Congress and President of the United States. All of the boards, all of the board of governors are appointed by the President and confirmed by the Senate. The bank presidents are appointed by the boards of directors, but they have to all be approved by the board of governors. So each one of the bank presidents has to be approved by the board of governors.
This is a question that I think is on a lot of people's minds. I've heard that the Federal Reserve is purchasing 70% of our new debt. Is this percentage accurate? Is this money printed to purchase the T-bills? What happens with these T-bills?
So if we purchase T-bills, what happens to the T-bills is they go on our account. Those T-bills yield regular returns to the Federal Reserve. The Federal Reserve returns those to the Treasury. The Treasury sees it as lower debt costs.
So one of the kind of things that I've heard mentioned a lot is with the Fed buying a lot of the debt, 1.3 trillion, that eventually that's going to lead to massive inflation, because whenever really the government's printed money, that has happened. What would be your response to that question?
Yeah. So I went to the University of Chicago, and I too learned MV equals PT. And just to go back to really old-fashioned versions of this, money times the velocity equals the price level times the transactions, the real transactions in your economy. So what's going on now that that we're seeing a really large increase in the balance sheet that I showed you. We don't hide that, we don't put that away. What's going on that causes that amount to change? Well, what's happened is the velocity of money, which was kind of assumed in that equation, was stable. The velocity is not stable. The velocity has fallen to, really quite low levels. Why is that? Because lots of the money that is supposedly there is not actually circulating. What matters to that pricing is the money that's actually used in transactions. So the money that's sitting on the balance sheet that is offset in the reserves, that are reserves held by banks that are not being used for lending, is not showing up in our inflation rate. Well, it is true that if you were to look at hyperinflation, that each time you had a hyperinflation, there was some lavish amount of government spending at some point. It is not the case that central bank balance sheets growing or shrinking are particularly predictive of inflation. So we can and must work to maintain the balance in reserves and money markets such that inflation remains around 2%.
This kind of goes along with it. Since there are 12 districts, are there different separate reserve discount and liquidity rates for each region?
That was historically true. I don't know when that stopped, but that was true in the early days of the Federal Reserve System. That was actually very helpful because if you thought about a largely agricultural economy, and a lot of the liquidity needs of people had to do with harvest dates and harvest activity times, that you needed to have somewhat flexibility across the country. With the amount of electronic communications there are now and the ability of banks and individuals to get rates from whomever they want throughout the country, there's no longer a need for sort of separate rates across the country. So they're exactly the same.
Is the Fed privately owned or government owned?
The Fed is a creation of the government. And the Fed is owned by the government. So here's let's talk through sort of where does this come from. So it is true that each of the Federal Reserve banks has shareholders. Those shareholders are required to own our shares. They're not allowed to adjust the number of shares they have. They're not allowed to shrink or expand them. They receive a fixed return on those shares regardless of what happens in the economy. Those shares are the shares of the member banks, and they're apportioned to the size of the member banks. If you wanted to think about what does that mean, it actually comes closer to resembling a tax on banks than it does a sort of normal shareholder. And banks, for a long time, were deeply resistant to having to hold these shares. Currently, they're not unhappy holding the shares because it has a fixed return. But it's not ownership in any sort of meaningful way. These shareholders are banks that are required to hold assets as part of being in the district that they operate in.
Okay, we're going to change course a little bit. Mark wants to take some live questions from the audience. If you want to ask a question, what I need you to do is come right down here. We're going to take 2 more questions that you've asked before we go to the microphone. The one criteria will be you must ask a question. And if you kind of go on the offensive, on the dramatic, we will go on to the next question. So, Mark, could you explain Keynesian economics and compare and contrast that with what you do at the Fed?
So I think of sort of what's called monetarist economics or Keynesian economics and all of these various things as a little bit historical analysis. I mean, economics has evolved with sort of how does it view things. There are elements of all of the prior theories that are sort of evident in the way you
Last question before we go live. Do you think having $16 trillion in debt is healthy for our economy, and what's the impact on the Federal Reserve?
Having $16 trillion of debt in the long run is something that's not healthy for our economy. And the chairman has emphasized that in the long run, you absolutely need a sustainable debt that's tied to the size and condition of your economy.
Okay, let's take some live questions. I'd ask you to state your name and please a question.
I'm Bob Graham. I noticed in your presentation the 2 things you missed. You looked at the employment figures at 8.1, and you didn't address the people given up work. And if you concentrate on inflation, but didn't pay attention to Bernanke's printing money and the value of the dollar's going down. And with that in mind, the $40 billion he's going to pump each month, which, based on what I understand, is going to go to support the housing market again through the banks. Are we not looking at loaning $40 billion a month to the people that brought us to the situation we're in now?
So again, there are a couple different questions there, so let me make sure I'm getting the various ones that I want to think about. So when we buy mortgage-backed securities, where does that money go? So it is not sort of loaning money to banks. So banks lend to households. They establish a mortgage, they sell that mortgage they put it into a mortgage-backed security. We're buying securities that are paying the yield on a bunch of different households throughout the United States paying their mortgage payments. So I think of it as being something where households are seeing more direct policy affecting the yields on, or the costs of mortgages in the United States.
You showed a graph there that showed government spending going down.
Yes.
Why has the national debt doubled in the last 4 years?
Well, I mean, so that was over the quarter. So, I mean, it was not a long-run picture. So if you're thinking about the national debt and why did it expand, there's a set of different things that happened. We had several tax reductions. Those tax reductions meant that there was less revenue coming in. There was some growth in spending over a 4-year period. If you're looking over the last year or so, in particular, state and local governments have been contracting the size of their activities. So that's showing up as, if I'm looking at the GDP accounts, I'll actually see that over the last 3 months, or over the last 6 months, the government is actually smaller than it was.
Next question is,
That's what the national debt was.
My name is Carl Frederick. I'm from the Oxford Tea Party. Your presentation was great. I do have one part though. We're told never to look at the future based upon the past. And you're showing that the future is going to grow. But I can't see that. I mean, with the past being going downhill, how can we say that in the future, everything in your graph shows we're going to get better in the future?
So I mean, it is the case that if you were looking at the GDP growth rates or you were looking at the unemployment rates, you would see that, the economy is expected to get better. One of the things that, a lot of people feel, and a lot of people, particular businesses feel, is that, a capitalist system is a very resilient system. That capitalism, when, allowed, will actually see growth pick up over time. A normal growth rate for our economy is about 2.5%. Normally, businesses over time will see opportunities, will expand to meet those opportunities. So I don't think about it as, what did we see over the last year? What do we expect to see? We expect to see the economy over time become more robust.
As a senior citizen, I'm very worried about that growth that you're talking about. Because we're living on not our interests anymore, but we're living on our principles.
Absolutely, and you should want to see that growth in the overall economy.
My name is John Dallas. I have a question about the velocity equation. It's money times velocity. Is that the first half of the equation?
That's the first half of the
Okay,
equation.
so what it looks like you're trying to do, because the velocity is so low, you're trying to blow that out higher and higher, putting more money into it. You're kind of overcoming the fact that banks and that are sitting on the money. You're pumping money in, but it's not getting out.
On the money they're pumping in.
Small business owners and that are saying, I've got a good rating and I still can't get a loan. So, what I'm trying to understand is why do you think doing more of the same thing to try to overcome the velocity is going to work?
And I actually think a lot about sort of what are we seeing on lending activity, and whether or not funds, are able to reach small businesses. In fact, some of my personal research is focused on small businesses and startup rates. What influences? Well, I think it's a really good question. It's one that we do pay a lot of attention to. So people were somewhat alarmed to see the mortgage-backed securities are being purchased here. Mortgage-backed securities produce lower mortgage rates for households. Households see that benefit. That's one of the reasons why there's a relatively direct impact there. When I talk to you about the rates, I want the rates on borrowing, whether you're a small business or medium or large-sized business, have been coming down. So we went through a bunch of, I showed a number of rates. I mean, there are, of course, infinite numbers of them. When you're thinking about small businesses, I mean, we spend a lot of time asking banks and talking to banks about what was the issue with small business lending. We spend a lot of time talking to small businesses to understand what do they see as the concern. And one of the things that was really quite critical in small business lending is small business loans tend to be collateral lending. And the collateral of any small businesses that they rely on is their home. When home prices are declining, that has a really large impact on the level or the availability of credit for that small business. That's one of the things that we learned about that. One of the things that I think is encouraging for our economy today is that we have seen the home price indices actually level out and moderately decrease.
I think one of the concerns is that you're blowing some bloom up in front of me, okay? And at some point, if that breaks loose, now you're going to go into a rapid rate of inflation.
Yeah, I mean, I think that is the concern that a lot of people have. The system is paying attention to sort of how do you make sure that we manage the rate that reserves are circulating in the economy. So one of the things that I talked to you about was the fact that we now pay interest on reserves. So one of the things that we can do is we can use that interest rate to manage how quickly monies flow out of what are currently uncirculating reserves into the broader economy. So that is one of the mechanisms that the system will use to help manage that process of seeing the balance sheet shrink as the economy is in.
Next question.
Jim Fitch, my question is, you're talking about gold not being stable. You go back before the Federal Reserve, countries were using gold, the gold standard, and the economy and inflation were much more stable. The instability is because when we're not in a gold standard, banks sell and manipulate the price, so they have created the instability. The stated purpose for creating the Federal Reserve was to stabilize the currency. Since the Federal Reserve has been around, we had the Great Depression, which Bernanke admitted was because of the Federal Reserve, and the dollar has lost over 95% of its value. We've had continuous booms and busts and bubbles and recessions. So the reality is the Federal Reserve has resulted in our economy being much less stable. It's eaten away at the value of the dollar, so that drives up the cost of gasoline. That's a major factor why it's $4 a gallon. And that drives up the cost of food and all these other products. How do you justify this? Or why don't we go back to the gold standard?
Well, I mean, so it actually turns out if you go look at the historical data during the period of time where the gold standard was, in fact, complete. I mean, before that, that there were actually very large swings in our economy. There were recessions and very large. There were a lot of very, very strong movements in the economy that ultimately resulted in recessions and turndowns and accelerations. They're actually sharper than what we've seen over the last 70 years.
And when did the Fed begin, Mark?
The Fed begins in 1913.
Okay, we're going to get a few more questions. Thank you.
My name is Dick Merritt. Could you go through the mechanics of how
how the money gets from the Treasury Department to the consumer. Just give us a little brief understanding of how that's done. My experience with banks has been, a lot of the banks don't really understand how this is working. And if you talk to people today, the people that are able to get the lower interest rates are the people that have extremely good credit ratings, and those are generally the people who don't even know in the first place.
So again, you know, and I keep realizing that when there are more than one question, I'm not always hitting all the answers. So I realize that.
Most important was getting the mechanics of how the money.
Yeah. So how do you think about money and money creation? So when you're thinking about when we create money, we're taking cash that's on our books that we can essentially create, and then we're purchasing securities. Those security holders receive the dollars
Can we
credited.
hold it down in the back, please?
Thank you.
Dollars are credited to the holder of that security. That security, those dollars are, you know, essentially part of the overall economy.
Obviously, so basically, let's talk about $40 billion a month. That money goes, that's money that the Treasury is printing, it goes to the Federal Reserve, and the Federal Reserve then buys, how does that money get from the Treasury to the consumer?
So
We always hear the story that they're just printing money and that's going to cause inflation.
there's not actually so much money being printed. So if you were thinking about dollars that are circulating in paper form, there are not actually, you know, such a rise in the dollars that are circulating in paper form. So if you were looking at the chart where I had the balance sheet, I probably, yeah, I cannot go back to it. So if you were looking at the dollars that, up until the financial crisis, that had a gradual upward slope, that is effectively mostly currency. Since that time, we've had additional purchases. We've changed sort of what we purchased, but what we purchased then was a set of treasuries and a set of, you know, there's some relatively small other categories. Since then, the composition of what got purchased got changed, but the effect is that the dollars end up in bank account, you know, end up in banks. But they gave us something that was worth a dollar. So we don't buy treasuries from the Treasury. The Treasury does not give us dollars. We buy from businesses, banks in this case primarily. We buy securities, and that becomes currency that's circulated. Now, what's happened, and this comes back to the MV equals PT sort of equation, is that a lot of those dollars that we put into the economy are not circulating, but have the effect of having gone into certain types of securities, for example, mortgage-backed securities. Those mortgage-backed securities, yields fell. Those yields are what will underpin a set of refinancing activities of households to see lower interest rates on their home loans. And most of that will happen through households across the economy. Those who are better or more able to, you know, refinance will be able to refinance their houses and see a lower interest rate. So we're not sort of subsidizing any particular credit risk. We're making the opportunity available to all households in the economy.
Well, it depends on the allocation because it's
So, and that's very important, and one of the things that we've seen that is very critical to see our economy be in a healthier state and to make progress from where we are today is seeing that house prices, that it was clear sort of where their valuation would sit. Housing needed to sort of see that floor on where house prices are. And I think we have seen that the economy has adapted and kind of understood, again, sort of what is the appropriate price for housing in the economy.
We're going to try to take 3 more questions. Thank you.
Hi, my name is Dick Husky. I'm a taxpayer. I'm puzzled by several of the charts that you put up because it looked like it was the opinions of members of the FOMC that suggested that everything started to look better in like 3 to 4 years. And I'm kind of curious as to what drove that thought process, because it's my opinion that it's probably driven by this thing that you're referring to as monetary velocity. Because right now it's not going anywhere. And it's my opinion that the reason for that is because we detect risk. We have no idea where the government's going. So, be quiet.
So, I mean, risk and uncertainty about the economy is something that, again, actually I've taken a look at some research, and I do think it holds back the economy. But, that's not something that I can, I or the Federal Reserve can control all amounts of business people's uncertainty about the economy. It's not something that we can say, oh yeah, I mean, if we just saw lower uncertainty, things would probably be better. We would see better investment levels. We would see more change in the economy that would be positive. But it's not something that FOMC members can, change very much by their own actions. So why do you see the economy making that progress? And so I showed you because I work for the Federal Reserve, because I think that the committee members' own descriptions of how they see the economy evolving is important. I showed you their projections. But those projections are actually not so different from what I would get if I went to look at business economists and their projections for the economy. Now, we have all been working on, sort of adapting and recognizing, hey, the model didn't always work right. We haven't always gotten it exactly correct. But what that's actually done is it's actually pulled down those projections. Those projections that look rosy to you now would have been, moderate to substandard as projections for how the economy maybe ought to evolve, 5 or 10 years ago. But to the best of our knowledge, those are, the likely path of the economy.
Thank you. Question. Hi, I'm T.C. Rogers. And if the banks can borrow at a funds rate of a quarter to a half, then to take the money and buy treasury bills at like 2.5, where they make their spread without any risk. So isn't the result a credit freeze on small businesses?
No, because if you think about treasury yields, so the 10-year treasury yield is currently, I'm probably off on, a couple hundreds. It's about 1.75%. But what is that yield? That yield is I'm going to get that 1.75% over the coming 10 years. So if I'm taking a 10-year treasury and I'm, getting short-term funds to pay for it, and let's make it a certificate of deposit instead, then I'm taking a lot of risk that I'm going to want to be locked into a 10-year yield of 1.75%. If instead what I said is I want to match up the assets and liabilities at the same basic time frame, you would discover that both rates are low and that there is no sort of extra premium there that the bank can sort of earn for free. The bank, if it's going to invest in long-term treasury securities, is facing the fact that it's locking itself into a low return.
Thank you.
My name is Judy Hughes. I'm from Lebanon, and I have a question about the Dodd-Frank bill that was passed by the Democrats in the House and the Senate.
Speak up. Put the mic closer, please.
Okay, in the Dodd-Frank bill that Congress passed, the Democrats have passed, it's establishing a Consumer Protection Bureau, and Congress is forbidden to hold any hearings into the financing or any of the financial records about this because the Federal Reserve is going to be signing it rather than taxpayer dollars through the House. So my question is, why is the Federal Reserve going to fund this bureau instead of the taxpayers to the House of Representatives? And what does it mean about you overseeing every financial transaction that consumers make? Are we going to be paying for fees for things like making deposits or withdrawals and selling stock?
did make the CFPB, the Consumer Finance Protection Bureau, funded out of the returns that the Federal Reserve is receiving. The Federal Reserve didn't create and does not manage the CFPB. The CFPB is its own creation of Congress, and I've let you, so in some sense, the right people to ask is Congress. It's not something the Federal Reserve really has much control over. Now, I can say that the CFPB has taken a look at a number of issues. One of the issues that the CFPB is focused on is trying to establish rules that banks were very interested in on mortgage lenders who were non-banks. Because I think if you look back at the crisis, one of the really difficult problems that we had as a country was that there were a lot of mortgage producers who, in retrospect, did not behave well. And there is evidence of fraud and complications, but it's not easy to actually get charges that work against those people. So one of the intent of the CFPB that I think I would say that I personally am in favor of is trying to make sure that we have broad rules on lending that include all forms of lenders and not merely banks.
Got one last question. I want to sneak one in. Is it the view of the Fed that the housing prices are at the bottom, or is it possible that they still will go down further?
So we don't publish, so yeah, I can't say the view of the Fed is because we do not publish a price index on housing. What I would note is that housing, after very steep declines in prices in many markets, are now up on year-over-year basis in most areas of the United States, and have for a while shown moderate growth across a wide variety of price indices.
Hi, my name is Tony, and I have really 3 questions. I'll go very fast. The first question on the data that you presented, is Obamacare baked into that data? And the second question is a Romney victory baked into that data? The third question, the last and final question is, I have this picture, you've seen Mission Impossible 1, and Tom Cruise goes into that room computer and you have a retina scan to get in. Does Ben Bernanke have a room like that when he expands the money supply and he goes into this room that's retina scanned and he types in 40 billion and someone's watching him, making sure it's not 400 billion or 4 trillion. I'm just curious about the logistics of expanding the money supplies. Those are my 3 questions. Thank you.
Okay. Maybe take number 3 first.
I'll say on the first 2, essentially what we use when we're thinking about projections is what does the market broadly think. So I basically use a lot of different inputs from financial markets and other places when I'm thinking about the model growth. And they have whatever assumptions they have. So I don't have any particular opinion on sort of what's likely to happen. But if you were thinking about the Obamacare as it would depend on sort of what is the market's expectations for whether that will happen, what's the cost of it, what do they think about that. Those things all show up in various indicators and are inherently part of the outcome.
I'm curious, but we had forecasts about things we're going to progress. So if the Obamacare into that, into the form of that forecast, what is the impact it's going to have on the economy? That you showed on the screen.
Yes and no. So the answer probably is the way that you would think about it. No, I don't directly try to say, okay, here's Obamacare, here's what I think it would do. In the sense that today's stock market, today's asset prices, all sorts of things reflect the market's view on how the economy is likely to develop, and it does show up. So that's more the way that I think about it showing up. And so that's why I emphasize market rather than sort of my trying to have a particular forecast on the many things that are happening in the economy.
And Mission Impossible?
The Mission Impossible question. So it turns out that, one of the things that, I, as a Federal Reserve employee, have seen is sort of where we actually do the transactions for mortgage-backed securities. So the chairman is, of course, not there. It's at the New York Fed. It's a relatively small number of people, but they've got all sorts of checks and balances to make sure that they are, one, transacting in the securities in the lowest cost way possible, that they are on target for their daily amount that they are expected to purchase, and that they don't see that their actions are unduly influencing the market in any particular way. But it turns out it's a pretty unimpressive operation. If you were to put this thing in a private bank, all of those people would be earning gigantic salaries. At the Federal Reserve Bank of New York, that's not the case. They're all regular people who are, doing their job.
Let's give our guest a round of applause.